I really can't think of a month where I'm not asked, what do I think about market valuations? And mostly, in an overarching sense, I always think the same thing about market valuations, which is years ago, I did the statistical work, which I've redone multiple times since, showing that valuations have never been predictive of where stocks will go in any time period that almost anyone gives a hoot about. That is, if we think about returns on a 3-month, 6-month, 1-year, 3-year, or 5-year basis, valuations are just not predictive. Valuations may make you feel afraid. They may make you feel comfortable. But those kind of feelings are not really very powerful for where stocks go. For every level of high or low valuation metric, whether it's price to earnings, price to book, price to dividend, price to sales for the market, there's a comparable level of the reverse with the same positive and negative return attributes afterwards. That's really hard for people to believe because the way we think like if I'm up high and I fall, I'm going to get hurt more than if I'm down low and I'm falling. So high valuations must be riskier. There's no actual evidence to show that that was ever true. There's a very convoluted formulation known as the Shiller P that's convoluted at best and shows a below average return when you use its convoluted valuation, but doesn't show a negative one. And in fact, most of the last now 30 years, it's said the market shouldn't be going up when the market actually has been going up. Although there are brief periods of time where it's been right, which is true of almost everything. What I want you to see is that if you're really very concerned about it, you should note that right now, the PE is not very high for the market by historical standards, 15 for the US market. And the way I would have you think about that, and I'm not telling you that that has anything to do with where stocks go next month, next year, or 3 years, or 5 years, because it doesn't. But that PE of about 15 is 1 divided by 15 if you flip it on its head into an earnings yield. When you do that, that's what you would have if you bought the whole thing as if it was a private business. And at this price, you'd get 1/15 in earnings coming back at you every year, or 6.7%. And compared to bond yields, that's pretty good. Compared to most other things, that's pretty good. It's lower than the current inflation rate, but the current inflation rate is very high compared to what it was even a few months ago and may not be this high for very long. That earnings yield is pretty good earnings yield. Most people would be happy with that if they could get it without the volatility of the stocks. You can't get it without the volatility of the stocks. But the fact of the matter is that still doesn't tell you where stocks are going to go in the next 1 month, 6 months, 1 year, 3 or 5 years. The valuations aren't predictive. Other things are predictive. I'm optimistic. I'm not optimistic because of valuations, but by the same standard by which most people think valuations are high, they're actually not. That might make you feel good. Thank you for listening to me. Subscribe to the Fisher Investment YouTube channel if you like what you've seen. Click the bell to be notified as soon as we publish new videos.